Welcome back to the practice for the last in first out inventory cost measurement method. Okay, we have the same transaction procedures, but the different inventory recognition from this last in, first out. We assume that last purchased, first inventory out when we sell this inventory. Okay, so as you can see that we will count the inventory cost of goods sold from this last purchase 25 at $18 per unit. Okay, this 25 and then this 25 from the purchase number one, and then finally the beginning. Okay, this last in purchased out. Okay, let's record the same procedure as the previous exercise. So inventory in by 350 and then cash, the same procedure. Cash out, then also the inventory up by new purchase, then cash out when we purchase this inventory 400. Then we made a sales, received cash by selling 40 units at $25, so $40 times 25, so 1,000. Then based on the matching principle, we should record the cost of goods sold and inventory we sold that inventory 40 units out of 60 units. Then how do we record this cost of goods sold and inventory? This inventory cost method, 40 unit. How do you measure these 40 units? The same way, same here, the cost of goods sold. Okay, we assume that this cost of goods sold inventory out from this 25 times $18 per unit plus, now how many units remaining? You have 15 units, right? 15 times 14 out of 15, so that we measure this 40 units out, right? So again, we started counting from the last purchasing, last in, first out. So 25 times $18 per unit, and then 15 out of 25 times $14 per unit. Okay, so 660 is the inventory. That is the inventory and the cost of goods sold out. That is the inventory sold, right? Based on the LIFO method. Then how to measure the tax expense? Tax expense, as we the practice, the same way, the sales minus cost of goods sold times 40%. So cash out 136. So as you can see that we have this cost of goods sold totally different amount from this the FIFO method, right? Then let's report this transaction journal entry into the balance sheet of the first year. Inventory, now we increased when they purchased, and then cash out. Then we add more inventory on the second purchase, and the cash out by 450, and then cash up 1,000 when we made the sales 1,000. Then the cost of goods sold was 660. Then out of this total inventory, we now measure this and the inventory when we measure this cost of goods sold from the last in, first out. Okay, and then the gross profit is 340. Income before tax, assuming that there's no other transaction, and then tax expense 130. And then cash out by paying cash the tax amount. Then the net income is 204. So within the earning is net income first year. Okay, So we balanced out for the first year. Okay, then second year transaction, we sold the remaining, the inventory 20 remaining inventory at $25. So again, 20 times $25. So the same amount, cash transaction, and then cost of goods sold, and then inventory out. How much do we record? Right here, 20 from this, and the remaining 10 from this, and then 10 from the beginning inventory. So we record 10 times 14 plus 10 times 10 units. So we record this 240, exactly same, the remaining inventory cost we sold, right? So we calculate the tax expense and cash out with the same procedure as the sales minus cost of goods sold times 40%, and then cash out 104. So let's post this transaction onto the last year. Okay, as practiced earlier, the the balance of the balance sheet is the ending balance of the prior year. So we have to start from then on. Then retained earning as well. So the cash up 500 when we made this 500, the sales of the second year, and then sales up 500. Cost of goods sold 240, and then inventory, because we sold the remaining inventory up. Then the gross profit is the difference between the sales and the cost of goods sold. And then income before tax 260. And then this tax amount $104. Then cash out when paid the tax amount, and then net income is 156, should be added into this retained earning, right? So the retained earning 360 are the same. Okay, so as you can see that we have totally different amount of this inventory first year and the cost of goods sold. So the cost of goods sold under this LIFO is expensive comparing this cost of goods sold on the FIFO. Why? Because the cost of goods sold in the first year under the last in first out LIFO, we count the most expensive one because we start counting the last purchased under the inflation. The inventory cost per unit was $18. So 25 at $18. Then 15 units at $14. That's why this cost of goods sold is expensive. But the inventory, ending inventory is the cheapest because the remaining inventory is the ending inventory, which is the inventory that the company purchased at the cheapest price. Okay, but anyway, the next year, the cost of goods sold is now from this inventory, which is the cheapest one, because it's the remaining inventory, we count as its cost of goods sold. Okay, under this LIFO, the tax payment is most the low amount because we count the expensive cost of goods sold first, and then second year the cost of goods sold is the cheapest one, and then tax amount paid more. Then let's compare the inventory valuation method through this the table. Cost of goods sold in the period, average cost. Let's just compare FIFO and LIFO. As I explained earlier, under the LIFO, cost of goods sold is expensive because we count the last purchased in, which is most expensive in the inventory first out. So the remaining, the the inventory definitely under the LIFO is the cheapest because the remaining is the inventory we purchased earlier at the cheaper price. Because we count this cost of goods sold, the expensive one, the gross profit, as you can see that gross profit is the lowest, right? The gross profit is 340. Because of this low, the gross profit, actual tax payment under the LIFO is very cheap. It's very low, right? Comparing other method. But the second year, the cost of goods sold under the LIFO now is the cheapest because the remaining ending balance of the last year was the cheapest ending balance, so 240. Because of this low amount of cost of goods sold, the gross profit is high at the same level of sales, and then they pay tax more. But when we combine this total cost of goods sold throughout these two periods are the same. All the methods are the same because we have the same capacity of this total inventory available sales, 900, right? So 900 was total capacity. So the point of this exercise is that how do we allocate this cost of goods sold based on the different inventory valuation method, right? And then the gross profit also same, but total tax also are the same. But why do we choose the LIFO? Why do we choose the FIFO? If we choose the LIFO, we pay tax lower in the first year. Nobody wants to pay tax first a lot. They want to the deferred tax as later as possible. So that is the one of the benefit. Also, LIFO has the LIFO reserve. That means that this gross profit of the second year is greater than others. That means that under the LIFO, the company can recognize the profit more later. Okay, this is LIFO reserve. But the tax amount in the second year is the higher than others. Okay, so that's it. See you in the next video clip, you guys. Bye bye.